this week's market update, 30 years on from Black Monday, China's Party Congress, and earnings season in full swing. Hot on the heels of the 10th anniversary of the financial crisis, this week sees the 30th anniversary of the infamous 1987 stock market crash. In a spooky coincidence, chaos in the world's financial markets that year came 4 days after a devastating storm had cut a swathe through southeast England. Investors will hope that history neither repeats itself nor even rhymes this year as the aftermath of Hurricane Ophelia blows through Ireland. The 1987 crash was the biggest one-day fall in markets since 1929. On Black Monday itself, October the 19th, the Dow Jones Industrials Index fell by 22.6%. There were similar plunges around the world, and by the end of October, Hong Kong was 46% lower and London 26% down. To this day, there's no real agreement about the actual cause of the crash. In the months leading up to it, markets had been particularly strong, with the Dow rising 44% as inflation and the oil price dropped sharply. So, one reason was simply overvaluation. Then, in the week leading up to the crash, geopolitics triggered nervousness after Iran hit an American-owned supertanker with a missile off the coast of Kuwait. On the Thursday night, the Great Storm felled thousands of trees across the south of England, causing markets to be closed all day Friday and leaving investors powerless to respond to mounting concerns for 3 days. One other possible explanation focuses on so-called program trading. Computer-driven trades triggered to protect portfolios from market volatility, but arguably causing more of it. As computerization expanded in the 1980s, the use of program trading grew significantly on Wall Street, and 1987 was the first big test of the new approaches. Whatever the causes, a weekend of anxiety burst into the open on Monday in the Far East, but accelerated in London trading after US warships retaliated to the attack on the oil tanker. One of the lesser-known facts about the 1987 crash, however, is the fact that despite the market chaos in October, most major markets actually ended the year higher than they started it. The crash failed to trigger the economic mayhem that many predicted, growth continued throughout 1988, and the Dow regained its pre-crash high in early 1989. In fact, looking back on 1987 with the benefit of 30 years hindsight, what's really striking is how hard it is to spot the crash on a long-term share price chart. What felt like the end of the world at the time has ended up being just a blip in the long-run progression of the stock market. For investors worried about a correction after an 8.5-year bull market, this is reassuring, even if a rerun of 1987 would still be a terrifying event, and even if there are some worrying parallels. 30 years ago, by contrast, China was a very different place. Less than a decade after Deng Xiaoping had initiated the economic reforms that would create a modern economic superpower, China was still a poor country, and its economic transformation still lay mainly in the future. As we were to find out 2 years later in Tiananmen Square in 1989, it was also still very much a one-party state suspicious of calls to accompany economic reforms with social liberalisation. 3 decades on, that at least remains the case, with President Xi Jinping being compared with previous strongman rulers of China, Mao and Deng. This week, we should get a clearer view of his vision for China as the 19th Party Congress gets underway on Wednesday. It marks the start of Mr. Xi's second 5-year term in office. The question now is whether he will continue the Deng legacy of opening up or pursue a narrower agenda of defending the party and indeed his personal position. This is a key Congress because for the first 5 years of his presidency, he was surrounded by men and women, mainly men, put in place by his predecessors. He now has the opportunity to deliver on the economic and social reforms that will be his contribution to China's remarkable development. And he will do so surrounded by people of his choosing. One unusual aspect of this week's Congress is expected to be the expression of so-called Xi Jinping thought in the party's constitution. This would only be the third time that a leader's name has been used in this way, further confirming his position alongside Mao and Deng, who likewise enjoyed having their thoughts and theories enshrined in Beijing's philosophy. Xi has been building up something close to a cult of personality over the years, and he was designated as core leader and commander-in-chief in 2016. That position had not formally existed in China since 1954. The Congress comes against a positive market backdrop in China, with the Shanghai Stock Exchange A-share index having doubled over the past 10 years, despite considerable volatility along the way. This year in particular, Chinese stocks have soared, boosted by internet giants Alibaba and Tencent. The broader MSCI China index has risen by 48% so far in 2017. Despite soaring markets and an apparently strong President Xi, there's another view that he's actually a weak premier who has failed to follow through on the ambitious pro-reform rhetoric from earlier in his first 5 years in power. With big question marks over high levels of corporate debt and financial risk, the ability of China to maintain its unique blend of one-party communist rule and freewheeling capitalism is less certain than it's ever been. Meanwhile, over in the clearly capitalist West, attention is this week focused on America's and Europe's third quarter corporate earnings season. Around 60 of the top 500 US listed companies are expected to announce results, and there are plenty of big names on this side of the Atlantic too. Over in the US, the banks are still in focus, with Morgan Stanley, BNY Mellon and Goldman Sachs wrapping up the big investment bank figures and probably confirming the slowdown in trading revenues announced by their rivals last week. But there's plenty else to watch out for, with figures from Procter & Gamble, PayPal, General Electric, Johnson & Johnson also due to report. In Europe, Nestlé, Unilever and Reckitt Benckiser come under the spotlight. Now, corporate earnings are key to the ongoing strength of stock markets, which set fresh records last week as weaker than expected inflation data gave investors hope that the Federal Reserve's tightening process may be slower and flatter than feared. The data, showing a 0.5% rise in headline consumer prices, but only a 0.1% increase in the core prices measure, did little to change the expectation that the Fed will hike interest rates again in December. The odds are above 80%. But policy in 2018 and beyond looks less certain, with weaker inflation raising expectations that a tightening labour market will struggle to lift price rises back to target. Stock markets, which have struggled to generate much investor enthusiasm throughout the long recovery from 2009's lows, are finally beginning to see some optimism on the back of expectations of tax cuts in America and a coordinated global economic recovery. The FTSE All-World Index has risen by 17% so far in 2017, and it's at a record high. While euphoria, the classic sign of a market top, is notable for its absence, still, some investors are starting to worry that a correction may be imminent, or at least a period of sideways moving markets, as valuations struggle to be justified by earnings growth. Meanwhile, in the rest of the world, politics continues to cast a long shadow. In Europe, an EU summit this week is being presented by the UK government as an opportunity for the other 27 EU countries to end the Brexit standoff, which has stalled negotiations in recent weeks. Elsewhere in Europe, Austria went to the polls and reawakened fears of a resurgent right after the Nationalist Freedom Party took 26% of the vote, its best result in 2 decades. And in Spain, Madrid has given Catalonia until Thursday to put up or shut up on its independence call. The government is threatening to impose direct rule if the rich northern region does not back off from secession. And in Japan, the country goes to the polls on Sunday, with Shinzo Abe hoping to win a 3rd consecutive term. The ruling Liberal Democratic Party is forecast to win 300 out of 465 seats, while Tokyo Governor Yuriko Koike's new Party of Hope is expected to provide the main opposition. Mr. Abe will be hoping to capitalise on a stock market feel-good factor, with the Nikkei 225 index standing at a 21-year high as it claws its way slowly back to the peak levels reached at the end of the 1980s property and stock market bubble.